1 week ago, the S&P 500 hit an all-time record high. And on that exact same day, the investor who predicted the 2008 housing collapse published a warning. Michael Burry, the man behind The Big Short. The investor who made $260 million betting against a market that everyone else said was fine. He wrote, and I am quoting directly, "I continue to believe it is possible we are near a major top, and possible a 1987-type fall." The 1987 crash he is referencing, Black Monday, was the single worst trading day in stock market history. The Dow Jones fell 22.6% in one day. And he said that on a day when the market was at an all-time record high. Here's what most people are getting wrong about this warning. They're treating it as a binary question. Is Burry right or is he wrong? That is the wrong question. And it is the question that will either cost you money or protect it, depending on how you approach what he actually said. Because Burry's track record is not what most people think it is. He was spectacularly right once. He has also been spectacularly wrong multiple times in between. Real quotes, real numbers, real stakes. Here is exactly what Burry said, in full context, because the headline version has been stripped of the nuance that actually matters. In his August 4th Substack post, titled Trading Post, August 4th, 2026, My Options, Burry wrote that he continues to hold short positions against the iShares Semiconductor ETF, Micron, Nvidia, Caterpillar, Palantir, Tesla, and Applied Materials. He described the S&P 500's 4-day 5% surge as similar to previous periods that coincided with major market turning points, including the dot-com era. He argued that rising markets, combined with falling volatility, force volatility-targeting funds to lever up, bringing additional momentum-driven buying into an already elevated market. And he compared that dynamic to the mechanical forces that amplified the 1987 crash. His specific positions, all short, are against AI-linked names, Nvidia, Palantir, semiconductors broadly. He believes AI infrastructure spending depends on financing that may prove unsustainable, that the revenue does not yet justify the valuations, and that when that gap closes, it closes fast and hard. Now, here is the context that most coverage of this warning leaves out. Every position Burry holds is currently profitable, except one, his short against Nvidia. Nvidia reports earnings on August 26th. If Nvidia beats significantly, Burry's core thesis takes a serious hit. If Nvidia disappoints or guides down, his thesis gets the data point it needs. Burry himself acknowledged this. He said he would cut losses if the trades moved decisively against him. That is not the language of a man making an unshakable prediction. That is the language of a man making a bet with a defined exit and being honest about the uncertainty. And today, the July CPI inflation report just dropped. Inflation came in at 3.9% year over year, slightly higher than the 3.7% analysts expected. Oil is rising again as the Iran deal that briefly sent crude lower last week has now collapsed. The Strait of Hormuz remains contested. And the Fed's September decision, which was looking increasingly like a hold, just got more complicated. The backdrop Burry described, elevated valuations, rising inflation, mechanical leverage, and momentum strategies, just got a piece of data that supports his concern rather than refuting it. Here is Michael Burry's actual track record, because the narrative around him is significantly more complicated than the Big Short story suggests. The win. In 2005 and 2006, Burry correctly identified that the U.S. housing market was built on fraudulent subprime mortgage debt, took a massive short position against mortgage-backed securities, and made $260 million for his fund when the market collapsed in 2007 and 2008. This was one of the most accurate and profitable macro calls in modern financial history. It made him famous and turned him into the character played by Christian Bale in the film. The misses. And there have been several. In 2021, Burry called the market the greatest speculative bubble of all time in all things, and predicted what he called the mother of all crashes. The S&P 500 subsequently rose another 26% before eventually correcting in 2022. His timing was significantly off. In 2022, Burry shorted the market heavily, going into what became a genuine bear market, but he covered most of his short positions near the bottom in June 2022. The market then fell further through October 2022. He exited too early. In 2023, Burry went heavily short again at the beginning of the AI boom. The S&P 500 subsequently rose 38% over the following year. His short positions cost his fund significantly. The honest picture of Michael Burry. He is a genuinely brilliant analyst who made one historically correct macro call. He has subsequently been wrong, or significantly early, on multiple large bearish positions. His short against Nvidia alone has cost his fund meaningfully in 2025 and 2026. He continues to hold it. That does not mean his current warning is wrong. It means it deserves to be taken seriously and critically, rather than either dismissed or treated as prophecy. Here is what the 1987 crash actually was, because the comparison Burry is making is more specific than most people realize. Black Monday, October 19, 1987, saw the Dow Jones fall 22.6% in a single trading session, the largest single-day percentage decline in the history of the U.S. stock market. 22% gone in one day. What caused it was not a fundamental economic collapse. The U.S. economy in 1987 was growing. Corporate earnings were strong. There was no recession. What caused Black Monday was mechanical, a combination of portfolio insurance strategies, which automatically sold stocks as prices fell, creating a feedback loop of selling that overwhelmed the market's ability to find buyers at any price. That mechanical dynamic, automatic selling amplifying a decline into a crash, is exactly what Burry is referencing when he talks about volatility-targeting funds being forced to leverage up in rising markets. He is arguing that the same kind of mechanical amplification that turned a normal correction into a 22% single-day crash in 1987 is building again, in a different form, through modern systematic strategies. Now, here is the honest comparison between 1987 and today. Similarities. Valuations are elevated. The market has had a strong run driven by a specific theme. Then it was junk bonds and leveraged buyouts. Now it is AI. Volatility is near multi-year lows, which encourages leverage. And there is a mechanical dynamic, systematic and momentum strategies that could amplify a correction. Differences. The Federal Reserve and global regulators implemented circuit breakers after 1987 that automatically halt trading if markets fall more than 7, 13, or 20% in a single session. A 1987-style single-day 22% crash is structurally prevented from happening in the same way. A significant correction, 10, 15, even 20% over weeks, remains possible. But the specific Black Monday scenario is far less likely in today's market structure. Burry's warning is not reckless. It is also not a precise prediction. It is a framework for thinking about how corrections can be amplified beyond their fundamental causes, and a reminder that markets at all-time highs with low volatility and high leverage are the environment in which those amplifications tend to occur. Here are the 3 moves that protect your finances. Whether the 1987 type crash Burry is warning about arrives, or whether the S&P 500 continues climbing for another year. Move 1. Do not make portfolio changes based on a single warning from a single investor. Burry is brilliant. He is also wrong, frequently and early. Every time he has issued a major bearish warning in the past 5 years, the market has continued higher for a meaningful period before any correction materialized. Selling your index fund because of a Substack post from Michael Burry is a strategy that would have cost you returns in 2021, 2023, 2024, and 2025. The information is worth knowing. It is not worth acting on alone. Move 2. Check whether your allocation is appropriate for your timeline, not for Burry's prediction. The right response to any crash warning is to ask one question. If the market fell 30% tomorrow and stayed conservative move. It is the move that makes every other investment decision possible. Michael Burry may be right. The market may be near a major top. The mechanical leverage building in systematic strategies may amplify the next correction into something more severe than the fundamentals alone would produce. The AI valuations may compress faster than anyone expects when the revenue story gets complicated. Or he may be wrong. Again, for the 4th time in 5 years. The honest answer? Nobody knows. Not Burry, not the Fed, not the analysts with the best models and the most data. What you can control is being prepared for either outcome. A 6-month emergency fund, an allocation that matches your timeline, and a long-term investment position that does not require you to predict the next crash to survive it. That is the only portfolio that does not depend on Burry being right. Here is what Michael Burry actually said, and what it actually means. On August 4th, the same day the S&P 500 hit a record high, Burry published a warning that markets may be near a major top and a 1987-type crash is possible. He is currently short Nvidia, Tesla, Palantir, Semiconductors, and Caterpillar. He believes AI infrastructure spending depends on financing that may prove unsustainable. And today, the July CPI came in at 3.9%, slightly above expectations, as oil rises again and the Iran deal collapses. The backdrop supports his concern rather than refuting it. His track record: one spectacular win in 2008, multiple significant misses or early calls in 2021, 2022, and 2023 that cost his fund meaningfully. He is a brilliant analyst, making a bet, not delivering a prophecy. 3 moves. Do not sell your index fund based on a single investor's warning. History shows this approach costs more in missed returns than it saves in avoided corrections. Check your allocation against your actual retirement timeline, not against the scenario you are most afraid of. And make sure your 6-month emergency fund is fully funded. It is the only protection that works in every scenario Burry describes. Burry may be right about the crash. He may be wrong. Either way, the right preparation is the same. And now you have it. If this video helped you think clearly about a warning that sent a lot of people into panic, hit subscribe. Every week on First Million Club, we take the loudest financial warnings and the most alarming headlines and show you exactly what the evidence says and exactly what to do about it. Stay smart with your money. I will see you in the next one.